Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're cutting through the noise and extracting actionable insights from a recent earnings call. A deep dive into DLF Limited's Q1 FY26 results.
Yeah, it was a really interesting call. Presented a fascinating dichotomy, actually. You had these genuinely impressive operational wins, but then the market reaction was, well, somewhat muted.
Exactly. So we're going to unpack exactly what drove those outcomes, what it means for the company's trajectory, and more importantly, what it might mean for you.
Our mission today really is to give you the most important nuggets of knowledge from this call, help you quickly grasp the key financials, the strategic shifts, and, the future catalysts for DLF.
And we'll explore why, despite some really stellar numbers in places, the market still processed the news with a bit of an adjustment and what that might signal.
Right. So where should we start? The headline figures.
Yeah, let's kick things off with the headline figures for DLF's Q1 FY26. Now, their GAAP EPS reported at 3.0 actually missed consensus estimates, missed by about 12.6%.
Which is, not insignificant, but then you look at revenue from operations.
Right, that was a significant beat. It soared past street estimates by a massive 43%, showing a remarkable 99% year-over-year growth. Came in at 2,716.7 crore.
Huge jump there. And profit after tax, the PAT, also saw impressive growth. About 18-19% year-over-year increase, landing somewhere between 763 and 766 crore.
EBITDA stood at 628 crore. But, and this is a key point we'll come back to, the reported gross margin came in at 28%.
And that 28% figure, I think, is where things get interesting, because despite that strong revenue growth and the healthy P8, we saw a slight dip in DLF's share price the day after the call.
Yeah, which is fascinating, isn't it?
It really is. And it suggests, that the EPS miss combined with that specific reported gross margin figure likely sort of tempered investor enthusiasm. It overshadowed some undeniably strong operational positives.
It really highlights the difference between maybe accounting recognition and the underlying economic reality, doesn't it?
Precisely. And understanding that difference, well, that's often where patient investors can find opportunities. It's a powerful insight for our listeners.
Okay, so building on those headline numbers, let's unpack the management commentary. Starting with the development business, which, it showed some truly robust performance.
Absolutely. New sales, or pre-sales as they call them, surged by 78% year over year, reached an impressive 11,425 crore.
Wow. What were the key drivers there? And just how significant are those wins?
Well, those pre-sales were primarily driven by two things. First, another successful launch in their Privana ecosystem. And second, the massive success of the Mumbai Phase 1 project. It was completely sold out, actually oversold in record time.
Oversold, really?
Yeah, incredible demand. And management really emphasized that the embedded margin from these Q1 sales was close to 4,500 crore.
Okay, let's pause there. Embedded margins, can you quickly clarify what that means for listeners?
Sure. So embedded margins basically represent the profit that's locked in from sales they've already made, but haven't fully recognized yet in the financial statements according to accounting rules. It's profit that's expected to come through later as the projects progress.
Got it. So future profit potential from current sales.
Exactly. And for the Privana North sales specifically, this translated to about a 40% margin, which importantly is consistent with their overall weighted average margin guidance of 45% for the whole product portfolio.
Ah, okay. So while the reported gross margin for the quarter was 28%, these future margins locked in from new sales are much healthier, around that 40-45% mark.
Precisely. That's the key distinction they were making.
And what about cash? Collections.
Collections for the quarter were also strong, came in at 2,794 crore. And that generated a net cash surplus of over 1,100 crore.
Which feeds into the balance sheet story.
Absolutely. This focus on efficiency saw their net debt significantly reduced down by 1,364 crore. It really reinforces the company's commitment to, net cash generation.
And looking even further ahead, what's the potential locked in those sales?
It's pretty staggering, actually. The gross margin potential just from sales already made stands at almost 24,500 crore.
24,500 crore.
Yep. And if you look at launch products, including the inventory they still hold, that potential margin exceeds 40,000 crore. The total cash potential from this entire product portfolio realized over time is projected at over 46,000 crore.
Those are huge numbers. But going back to that reported margin, with management stressing these strong embedded margins, isn't there still a risk? If these projects take longer to recognize, or if market conditions shift before that value actually hits the books, how confident can investors really be?
That's a critical question, absolutely. And management addressed it directly. They clarified that the 28% reported gross margin figure wasn't about core economics deteriorating. It was a reflection of the product mix.
Product mix, meaning which specific projects had their revenue recognized this quarter.
Exactly. Specifically, the recognition of revenue from older projects like Old Monsoon Town or OMT and Garden City. These simply have different, likely lower margin profiles compared to the newer launches like Privana or the Mumbai project.
Okay, so it wasn't that the new stuff is less profitable. It's just that the older stuff recognized this quarter had lower margins baked in.
That's what they stressed. They insisted the embedded margins in the new projects remain very healthy. And this signals, strong future profitability as these new higher margin projects come to fruition and get recognized on the income statement.
So it's that potential disconnect again, isn't it? Between the short-term reported metrics and the underlying long-term value creation.
It really is. And what this often signals, for those with a keen eye, is a potential mispricing, where the market might be focusing too heavily on current accounting numbers instead of the future economic reality.
Interesting. Okay, let's shift gears slightly. Moving beyond the development business, what about the growth in their annuity or rental portfolio? That provides a sort of long-term anchor, right?
It does, and it's a strong picture there, too. The operating portfolio, the rent-generating assets, now stands at 46 million square feet. And crucially, with a robust 94% occupancy rate.
That's very high occupancy.
It is. And DLF CyberCity Developers, LTD, or DCCDL, that's their key annuity arm, saw its rentals grow a healthy 15% year over year and 12% just quarter over quarter. DCCDL's PAT, its profit, was up 26% year over year.
So steady growth there. Any new assets coming online?
Yes, significant ones. They received occupancy certificates, or OCs, for downtown Chennai. That one's already over 99% leased, basically full. And also for Midtown Plaza, which is over 80% pre-leased already.
Good momentum on leasing then.
Very good. And the OC for another one, Atrium Place, is expected this current quarter.
What about upcoming rental contributions? Anything new starting to generate income soon?
Yeah, they highlighted 3 new malls, High Street Plaza in Modi Nagar, Midtown, Summit Plaza in DLF Phase 5, and the new mall in Goa. All of those are expected to start contributing their first rentals from Q4 of this fiscal year, FY26.
So end of this fiscal year, we should see a bump from those.
That's the plan. Though it's worth noting, the Goa Mall completion is slightly delayed by about a quarter. They now expect it ready by January.
Okay. And did they give any guidance on where they see overall rentals heading?
They did. Management guided for total exit rentals. That's a run rate expected by the end of the period to reach approximately 6,700 crore by March 2026.
6,700 crore annually.
That's the annualized run rate target, yeah. About 5,900 crore of that coming from DCCDL itself, and the rest around 750 crore from other assets. It really demonstrates their commitment to building that stable, recurring income stream alongside the development business.
And this commitment to the annuity side, it must be reflected in their capital allocation strategy too.
Absolutely. They plan significant capital expenditure CapEx specifically for these rent-bearing assets, around 5,000 crore in FY26 and another euro 5,000 crore planned for FY27.
10,000 crore over 2 years just on rental assets. But how are they funding this, especially with all the cash generated from sales? Doesn't that just flow straight through?
Well, that's where it gets a bit nuanced. While the company generates substantial cash from sales, remember, a large portion gets held in specific RERA accounts until project completion.
Ah, right. RERA, the Real Estate Regulation and Development Act, those escrow accounts designed to protect buyers.
Exactly. So it's not just an accounting thing. It's a regulatory requirement that significantly impacts how cash flows are managed in Indian real estate. Management clarified this. They said significant excess cash for, alternate discretionary use is probably still about 1 to 1.5 years away.
So not immediately available for, say, big share buybacks or dividends.
Not in huge quantities yet. They said a real big quantum of cash for alternate uses is more like 24 months out as those RERA balances gradually moderate and get released upon project completion.
And what are their preferred uses for that free cash once it becomes available?
They mentioned 2 main priorities: funding further growth or shareholder returns. And they also remain open to opportunistic land acquisitions. They pointed to the successful Mumbai investment as an example, and mentioned smaller potential consolidations too.
Okay, so we're seeing this cycle. Impressive cash generation from the core development projects, which then strategically feeds into the stable long-term growth of their annuity business. But of course, the development pipeline is where the next wave of cash generation comes from. What's the outlook for new residential launches?
Well, as we mentioned, the Mumbai Phase 1 project was a huge success. They expect approvals for Phase 2 within the next 12 months or so. And interestingly, they said they're openly considering a second project in Mumbai entirely.
Expanding their footprint there significantly then. What about other key projects like Dahlias?
Dahlias, they said, is approximately 50% sold, and sales are continuing, importantly, at higher price points. Now, the formal launch of the Experience Center for Dahlias has been pushed back to March-April 2026.
Pushed back. Why?
They cited the sheer grandeur of the product and complexities involving international design elements, but they were quick to assure that sales won't stop in the meantime.
Okay. And Goa? Any residential there?
The Goa residential launch is still pending final approval, so that's on the cards but not immediate.
And looking further out, any other major launches planned?
Yeah, a couple mentioned for FY27. Hamilton Phase 2 IDO, that's an integrated development opportunity in DLF City, is slated for then. And the next phase of the Midtown project in Delhi is probably about 2 years out, so targeting FY27 or maybe FY28.
So a steady pipeline replenishing the development engine. If we sort of connect all these threads, DLF's Q1 results seem to present a pretty nuanced narrative for investors, don't they?
Absolutely. You've got the substantial pre-sales, the significant debt reduction, the robust growth in the rental portfolio. It all clearly points to strong operational momentum and, frankly, sound financial health.
And the company's strategic pivot, this move towards a more balanced development plus annuity platform, seems to be playing out, funding that recurring rental income growth with these cash-rich launches.
It's a compelling long-term story, yes.
So what does this all mean for you, the listener, the investor? While that GAAP EPS miss and the lower reported gross margin, even if it was just mix-driven, clearly impacted immediate market sentiment.
Management consistently hammered home the health of those embedded margins, right?
Yeah.
Around 40% for the Q1 sales, and the strong future cash generation potential.
But while management stresses these embedded margins, isn't the market's focus on current reported numbers still a legitimate concern for short-term sentiment? I mean, the stock did dip.
It is. It's a classic investment dilemma, isn't it? The market often fixates on the immediate, the headline numbers. Sometimes it misses the underlying value that's being carefully built over the longer term. We've seen this pattern before in various sectors.
And the broader context helps here too, presumably.
Definitely. The industry backdrop in India right now, especially with premium and luxury segments really leading housing sales, they represented over 60% share in the first half of FY25. That plays directly into DLF's strengths. They're a branded developer with a strong luxury pipeline in key markets like NCR and Mumbai.
So the market trend is kind of meeting their core competency.
Precisely. And you see analyst sentiment reflecting this longer view. While they noted the short-term misses, they generally remain bullish on the fundamentals. You saw BUY ratings from major houses like HSBC, JM Financial, ICICI Securities. ICICI even suggested potential for zero net debt by FY30.
Zero net debt?
Wow. So analysts seem to be looking past the quarterly noise.
Largely, yes. It suggests they see this disconnect between the short-term reported metrics and the underlying long-term value creation that's building up.
So key catalysts for investors to watch going forward would be, I'd say, watch the continued absorption rate of projects like Privana and Dahlias. Are sales holding up? Keep an eye on the timing of the Goa launch and Mumbai Phase 2 milestones. And, critically, track the leasing velocity of those new commercial and retail assets set to come online, especially from Q4 FY26 onwards. That will be key to validating the annuity growth story.
Okay. Given all we've discussed about this, apparent disconnect between the market's initial reaction and the underlying fundamentals, it naturally leads to thinking about how one might approach this from an investment perspective.
Right. And while we always say this is absolutely not financial advice, just exploring ideas.
Let's explore a thought experiment then, or this is not financial advice segment.
Okay. So considering DLF's strategic shift and that market reaction, here's a thought. We're calling it the embedded value dislocation long.
Intriguing name. Explain.
The basic idea stems from the market focusing heavily on that reported 28% gross margin, which we've established was largely a product miss issue, and the EPS miss.
Right, the short-term negatives.
Exactly. But management repeatedly stressed the embedded margin from current sales is much higher, around 40%. And remember that huge number, the gross margin potential for sales already made stood at almost 24,500 crore. That's a significant future profit stream not fully reflected in current quarterly reports.
So the trade idea is based on that future value being underappreciated right now.
That's the core idea. You'd consider going long DLF equity, probably with a multi-year horizon, betting that the market eventually looks beyond the optics of a single quarter's reported margin.
And anticipates a re-rating.
Yes, a re-rating for DLF based on realizing those robust embedded margins, the massive cash flow potential coming from existing projects, and, importantly, the successful execution of turning that development engine into a balanced cash-generating annuity platform.
So it's a bet against market short-sightedness, essentially.
You could put it that way. It capitalizes on this perceived gap between the market's immediate reaction and DLF's long-term structurally sound growth narrative. And, management's apparent bewilderment on the call about the stock drop, despite strong pre-sales and cash generation, kind of points directly to this potential dislocation in perception.
A fascinating thought experiment indeed. Okay, let's recap this deep dive.
Sure. DLF's Q1 FY26 really showcased exceptional pre-sales performance and a strong reduction in net debt. It validates their strategy, doesn't it? Leveraging successful launches to bolster the balance sheet and simultaneously fund the expansion of their rental business.
Yeah, absolutely. And while the reported EPS did miss consensus, and that gross margin figure appeared lower, mainly due to product mix management, consistently reiterated the health of the embedded margins.
And underscored the robust growth trajectory of the annuity portfolio. The company seems strategically focused on strengthening operating cash flows and building out that balanced development plus annuity platform for the long haul.
So a lot to unpack, and definitely a nuanced picture beyond the initial headlines.
Definitely. And just a reminder to everyone listening, this information is purely for educational purposes. It should absolutely not be considered financial advice. Always conduct your own thorough due diligence before making any investment decisions.
We encourage you to continue exploring these themes. What stands out to you from this deep dive? Let us know.
Thank you for tuning in to the deep dive.
We look forward to your insights and joining us for our next deep dive.